Yeah, our philosophy and approach to managing money for clients is actually pretty well founded and has a lot of history. You would identify, if you did some research, that most major institutions and very wealthy families utilize a very similar approach. And it really is a result of our perspective that most clients today find that when they're working with any kind of a financial advisor, the lion's share of their investment portfolio is subjected to the ups and downs of publicly traded securities, effectively stocks and bonds. And as we review portfolios for clients and run some risk tolerance questionnaires, we find that oftentimes their portfolio is invested considerably more aggressively, or arguably more taking on a greater level of risk than what their risk tolerance propensity tends to indicate. So our view is that it's appropriate to have some of your portfolio in publicly traded securities. They're liquid. There's a good long-term performance history that we want to participate in, but it doesn't make sense to have all of your assets limited to that marketplace. So the publicly traded aspect of our portfolio management style we refer to as core. You know, a long time ago we came up with this concept that we could divide portfolios into three major segments. Core would be the publicly traded securities portion. Opportunistic, which we'll visit as it relates to a number of different opportunities, and then risk protected. In the core component of that TRIA formula concept, that's where we're addressing the publicly traded securities market, the stocks and bonds. And our approach is if we can generate a rate of return in positive stock markets, bull markets, where we're getting 90 to 95% of the market return, but in down markets, when there's a bear or there's a drawdown, like we see during recessionary periods or declines in equity markets, we only experience maybe 60 or 65% of the decline, then we know over a long period of time that we're going to generate performance that is roughly 0.5% to 1% per year on average better than somebody who's being an unmanaged index fund. And that's net of fees. So I don't know that people hire us specifically for our expertise in the core arena, but our role, we feel, is just let's not screw that up. Let's participate, have a benefit there, have liquidity for access. The other two segments, opportunistic and risk protected, I think are very relevant, but often ignored by the financial community. You know, in the opportunistic space is somewhat self-evident. And if you think about periods of time during history, you can look at capital markets from a 40, 50,000 foot view and typically identify where there's going to be some outlying opportunity going forward. So I use the example, if you go back to 2009 or 2010, you didn't really have to be all that bright to realize that rental property was going to be in pretty high demand coming out of the Great Recession. So probably a lot of stockbrokers overweighted clients' portfolios with multifamily development companies or possibly property management companies. Our view was the real opportunity is to own the real estate. So why wouldn't we have our clients buy apartment buildings? The opportunity for upside performance is considerably more substantial than a diluted performance of a publicly traded security. Similarly, when energy markets move up and down, you can go back to 2015, 2016, we saw in a relatively short period of time, energy prices decline from $104, $105 a barrel to 28. And then as they started to recover back into the 40s, it made sense probably to deploy capital in that energy space. But rather than buy a stock like an Exxon or British Petroleum in our core portfolio, our view was, why don't we own mineral rights? Or why don't we own mineral acreage or royalties for drilling oil? And again, the client has a much higher degree of potential return and performance opportunity than they would by owning a publicly traded security. So really in that opportunistic space, most of our clients have somewhere around a third to maybe 40% of their portfolio invested, but we'll have them in at least 10 or 12 different individual opportunities, because we know that no matter how good a due diligence we do in that arena, some of those investments aren't going to do as well as we thought they would. Some are going to do a lot better than we thought, and hopefully 6 or 7 in the center kind of hit our targeted rate of return or expected rate of return for that space. So the other nice thing about having 10 or 12 different investments is they're disparate in their lack of correlation as well. So not only does that whole opportunistic space tend to move independent of the stock market. You know, if you own an apartment building, it doesn't matter if the stock market declines 30% next year, you're still collecting rent every month. So that's a lack of correlation, which is very attractive for client portfolio. But similarly, an apartment building doesn't necessarily perform the same as an industrial property, or owning an operating business doesn't perform the same as the energy markets. So if we can give our clients multiple levels of exposure in that opportunistic space, we expect that that's going to decline or allow them to see a reduction in their Sharpe ratios and their volatility and day-to-day risk that they're anticipating or experiencing as well. And then finally, the third quadrant we refer to as risk protected. And this is really just a methodology where we've been able to go to major insurance companies and negotiate a relationship where if we leave capital on deposit on behalf of our clients there for a period of time, that carrier will credit interest based on tracking some kind of an index metric. Now, it could be really simple. It could just be tracking the Standards & Poor's 500, the S&P 500, or the Dow. But in most cases, we found organizations where they have multi-asset based benchmarks or index that they're tracking. So they're going to track U.S. stocks, U.S. bonds, European stocks and bonds, Asian stocks and bonds, but they're also going to track hard assets. So they're going to look at the real estate market. They're going to look at commodities markets, look at energy markets, and create a blend. But at the end of the day, regardless of how they design that index, and oftentimes they've recruited Nobel Prize winning economists to do these, to derive the indexes. But at the end of the day, their commitment to our client is if that index goes up 8% during the tracking period, they're going to credit our client 8% interest. If it declines 8%, they're going to credit 0. So we have a risk-protected element of this where we don't see a decline in principal value, yet we're still able to fully participate in the upsides of markets. You can probably imagine when you take all three components, risk-protected, opportunistic, and core, and you blend them together on a customized portfolio based on a client's individual circumstances, tax metrics, and risk propensity, that the performance opportunity there is usually 1% to 2% a year higher. In fact, we do back testing where we'll go back and show a client, here's how your portfolio's performed starting in 2007 through a couple down markets in 08 and 15. And then let's contrast that with what would happen if we had used a TRIA formula mentality at that period of time. And in almost all cases, we'll see a decline in risk of about 1/3 from what they're currently exposed to, and a dramatic reduction in volatility. Probably over half the volatility is eliminated, yet an improved rate of return. They'll gain 0.5% or 1% per year average annual rate of return by using that philosophy. In reference, it's well-founded and historical. I think the novelty is that we haven't seen this strategy deployed for retail investors very frequently. It's really an institutional mentality. In fact, if you look at how Harvard or Yale or Stanford manages their endowment funds, it's pretty much the same exact process that we're using. We just found a way to deliver it down to the average investor.